If you look at the glittering lights of the Las Vegas Strip, you probably think you are looking at massive gambling enterprises that make their billions from blackjack, roulette, and slot machines. But if you open up the SEC filings of the world's largest gaming companies, you'll discover a shocking truth. The biggest players in the casino industry don't actually care who wins at the poker tables. They are secretly running one of the most aggressive real estate monopolies on Earth. Over the past decade, the entire casino business model underwent a massive structural transformation. Historically, a company like MGM or Caesars owned everything: the land, the building, the slot machines, and the hotel staff. But holding massive, expensive physical buildings on your balance sheet is terrible for a public company's valuation. Buildings require constant repairs, tax payments, and massive capital expenditure that drags down corporate profit margins. To solve this, the industry executed a brilliant financial split. They divided companies into two entirely separate entities: operating companies and property companies. The operating company manages the actual casino floor, pays the dealers, runs the marketing, and takes the operational risk. Meanwhile, the property company owns the physical dirt, the concrete, and the high-rise towers. The property companies were spun off into real estate investment trusts, or REITs, with giants like Vici Properties buying up the underlying land of iconic landmarks like Caesar's Palace, the MGM Grand, and the Venetian. Then came the real financial masterstroke: the triple net lease. Under a standard triple net lease, the casino operator agrees to rent the physical building from the real estate owner. But the casino operator doesn't just pay rent. They are legally required to pay the rent, plus all the real estate taxes, building insurance, and structural maintenance costs. Think about how brilliant this is for the real estate owner. Gambling revenue fluctuates wildly based on economic recessions, seasonal tourism, or a few lucky high rollers having a good weekend. But real estate rent payments do not fluctuate. By locking casino operators into long-term, multi-decade triple net leases, these real estate trusts converted unpredictable high-risk gambling revenue into guaranteed, inflation-protected, contractual cash flow. Today, companies like Vici Properties collect billions of dollars in guaranteed rent every year, regardless of whether the people playing slot machines inside those buildings are winning or losing. This structural shift reveals one of the most important principles in wealth building. The consumer-facing layer of a business, the games, the products, the customer service, is volatile, risky, and expensive to maintain. The real, compounding wealth is almost always held in the underlying finite assets that control the infrastructure. If you want to build true, long-term financial security, stop focusing on playing the game and start focusing on owning the board.